An airline ordering 100 jets in a single afternoon makes the front page of the financial press.
Right. It is highly visible.
The manufacturer, whether it's Boeing or Airbus, secures the headline immediately. But the central thesis of the commercial aviation industry is that getting the headline is the easy part.
Yes, the headline orders are essentially an illusion.
Today, we are analyzing a comprehensive stack of aerospace financial reports and IATA data with a specific mission.
To uncover why the world's largest manufacturers are securing record numbers of orders, yet struggling to convert those orders into cash.
Exactly. We are going to look at the actual scoreboard, which is the delivery line. Selling an aircraft simply proves a customer wants it.
Delivering that aircraft proves the industrial system can actually function.
I mean, the engines had to arrive, thousands of components had to arrive.
The regulators had to be satisfied, and the financing had to clear.
Only then does the commercial promise convert into cash. We can establish the baseline by looking at the snapshot from July 2026.
Let's look at the numbers.
Airbus delivered 67 commercial aircraft.
Right.
That brought them to 418 deliveries for the year.
And Boeing delivered 53.
Those orders answer a relatively simple question. They answer who persuaded the airline management team to sign a contract.
Deliveries, however, answer a much more difficult question. They tell you who can force suppliers, regulators, logistics networks, and capital markets to arrive at the exact same physical location concurrently.
That is the true definition of industrial execution.
It is. Over the life of an aerospace cycle, that operational execution dictates the balance sheet far more than who had the better week at a global air show.
Because industrial execution matters more than order volume, you have to look directly at the cash flow disconnect.
The aviation industry is not short of customers.
No, it is short of the ability to deliver enough aircraft, fast enough. The macro scarcity metrics from IATA outline this clearly.
What are the current IATA figures?
The global aircraft order backlog has moved above 18,000.
Right. An enormous figure.
And delivery shortfalls currently exceed 5,000 aircraft.
Which means the average global fleet age has climbed above 15 years.
This is a crisis of execution, not a crisis of demand.
To understand how that backlog signals demand, but delivery is what actually drives cash conversion, you have to look at the balance sheet realities.
Boeing's second quarter of 2026 provides the initial benchmark here.
Yes, looking at Q2 2026, the company delivered 171 commercial aircraft.
And revenue reached $24.6 billion.
And free cash flow positive by roughly $0.6 billion.
The higher commercial deliveries directly funded that cash position.
Airbus demonstrates the exact same mechanical relationship, but from a very different position on the balance sheet.
In the first half of 2026, Airbus delivered 351 commercial aircraft,
generating about $33.2 billion of revenue.
However, free cash flow before customer financing was still negative by roughly $1.2 billion.
Right. I want to pause on that specific metric.
It is a striking divergence.
How can Airbus generate $33 billion in revenue, maintain a record backlog of orders, but still post negative free cash flow?
Well, to an institutional investor looking at a normal business, record orders should translate to record economics.
But in aviation, it proves that a backlog is a liability as much as it is an asset. A large order book creates obligations.
Working capital remains entirely tied up as Airbus funds its production ramp.
Think of working capital in aviation like a massive traffic jam. Airbus has already paid suppliers for the landing gear, the avionics, the cabin seats, and the fuselage panels.
That cash has left their balance sheet.
Yes. But until the engines arrive and the aircraft is fully certified and handed over to the airline, Airbus cannot collect the final largest payment.
The money is just stuck in traffic on the factory floor.
The manufacturer has promised future aircraft, which means suppliers have to build capacity and hire workers today. Inventory accumulates before delivery.
If a handover slips by even a few weeks, the financial problem does not remain isolated inside the factory. Working capital stays locked.
If you have ever tried to renovate a kitchen and had to wait 6 months for a specific Italian cabinet hinge to arrive,
you multiply that logistical headache by $1 billion, and you begin to understand the current aerospace supply chain.
That establishes a permanent rule of aviation economics. Selling measures commercial power. Delivering measures industrial power.
If delivery is the only way to monetize the backlog, we have to examine why scaling production is proving so difficult.
The core issue is that Airbus and Boeing do not actually build the entire airplane.
Right, they are essentially final assemblers of highly distributed systems.
The final assembly line carries the famous brand name, but the production rate is often determined by a sub-tier supplier most passengers have never heard of.
Engines, landing gear, actuators, forgings, and specialized materials come from networks of independent certified suppliers,
The constraint is currently centered on the engine manufacturers. Boeing and Airbus rely heavily on CFM International.
which is the GE Aerospace and Safran joint venture.
Exactly. And Pratt and Whitney, part of RTX, for narrow-body engines.
We should look at a specific physical constraint to explain the mechanism here.
Pratt and Whitney's geared turbofan fleet required accelerated inspections linked to a powder metal manufacturing issue.
A powder metal issue might sound like a minor technicality, but in a geared turbofan engine, a microscopic flaw in the metallurgy means the engine operates under severe risk of failure at high temperatures.
It is not a software bug you can patch remotely. It is physical chemistry.
The engine has to be physically pulled off the wing, transported to a shop, and entirely torn down.
That metallurgical reality increases engine removals, consumes spare parts, and puts severe pressure on global maintenance capacity.
It highlights a critical vulnerability in the industrial base. New aircraft production and the existing airline fleet draw on the exact same overlapping pools of parts, skilled labor, and supplier output.
Yes, when Pratt & Whitney has to divert new turbine disks to repair existing engines, those disks cannot go to the Airbus final assembly line.
A problem in one part of the ecosystem immediately spreads through both manufacturing and maintenance.
This brings up what we can call the illusion of speed. You cannot simply swap an aerospace supplier because another company offers a similar component.
If an automotive manufacturer is short on microchips, they might pivot to another supplier within months.
But in aviation, a substitute supplier requires new tooling, extensive documentation, manufacturing qualification, and, most importantly, regulatory approval.
The fastest factory in the network is completely irrelevant if one critical certified node is late.
Technology is often presented to institutional investors as the ultimate solution to supply chain friction.
Artificial intelligence can improve logistics scheduling. Computer vision can support factory floor inspections.
Digital twins can reveal production constraints earlier in the design process. But software cannot eliminate metallurgy.
It cannot bypass physical certification timelines or physical lead times for raw materials.
You can optimize the queue with software all you want. You cannot code a qualified titanium turbine component into existence.
The regulatory and geographic realities add further friction to that timeline. A certified aircraft is a regulated product from nose to tail.
If a design change or a production issue requires additional regulatory review, that time carries an economic cost just as surely as a missing physical component does.
Furthermore, aircraft depend on titanium, nickel alloys, aluminum, composites, and specialist electronics.
Those raw inputs cross borders several times before the finished jet reaches its final customer.
Tariffs, export restrictions, customs delays, logistics failures, or a weak sub-tier supplier in a different hemisphere can turn into an aircraft delay many steps later.
If you are flying this holiday season and notice your ticket was unusually expensive, or you were squeezed into a 20-year-old plane,
You are feeling the direct downstream effect of a missing part in a factory on another continent.
economically, an aircraft is effectively a global supply chain with wings.
With the supply chain constrained in this manner, Wall Street has fundamentally changed its measurement of a winning aerospace manufacturer.
Evaluating output requires looking past the baseline delivery numbers. Boeing's second quarter of 2026 output of 171 deliveries was its highest quarterly total since 2018.
However, raw volume is not necessarily the metric that matters to a manufacturing contest operating over a multi-decade cycle.
What does that mean for the institutional investor, though? If raw volume is not the correct metric, what exactly is Wall Street measuring?
The durable metric is quality-adjusted production.
Investors are no longer valuing raw demand. They are valuing the probability that demand can be manufactured profitably.
Wall Street scrutinizes inventory levels, working capital buildup, certification progress, margins, and the financial health of the sub-tier suppliers.
A factory can increase its monthly output and still destroy economic value in the process.
If a manufacturer states they are building 40 aircraft a month, but 15 of them require extensive rework or have to be parked on the tarmac waiting for a specific rudder component.
The quality-adjusted rate is 25.
Right. If rework rises, if unfinished inventory accumulates, or if workers are stretched faster than training protocols allow, increasing output is a net negative for the balance sheet.
The optimal production rate is not the highest number management can announce on an earnings call.
No, it is the highest rate the entire certified supplier network can sustain.
This industrial scarcity causes a permanent shift in bargaining power. Boeing and Airbus benefit from operating in a duopoly with very few credible alternatives for large commercial jets.
But the physical scarcity moves the actual leverage further upstream.
The true power players become the reliable engine supplier,
The certified component maker that actually possesses spare manufacturing capacity.
or the large aircraft lessor who already owns an operating asset.
Control sits with whoever owns the hardest thing to replace.
That upstream leverage directly dictates the economics for the downstream players, primarily the airlines and the consumer.
Put yourself in the position of an airline management team operating in the middle of this equation.
They plan their capital expenditure expecting 10 new aircraft to arrive next year.
Those aircraft were supposed to replace older, fuel-inefficient equipment, allow the airline to add new routes, and increase frequency on profitable hubs.
When those deliveries slip by a year or more, the airline still has passengers holding tickets.
They still have flight crews on payroll, expensive airport slot commitments, and a network schedule they have to protect.
Management is forced into defensive maneuvers. They must keep older aircraft flying much longer than planned.
Every single one of those defensive options carries a severe, quantifiable cost.
When an airline delays retiring a 20-year-old jet, they burn significantly more fuel.
The older aircraft requires heavier, more frequent maintenance checks, which cost millions.
The specific IATA estimate models that these aviation supply chain failures cost airlines at least $11 billion in 2025.
That cost flows directly through extended leasing premiums, additional fuel consumption, and increased maintenance burdens.
That operational constraint eventually hits the consumer.
Airfares depend on demand, fuel prices, seasonality, and competition.
But when aircraft shortages limit how quickly an airline can physically add seats to the market, capacity remains much tighter than management originally planned.
For you, the consumer, this leads to firmer fares on constrained routes and slower network expansion.
Airlines sit inside complex airport slot systems and connection banks.
If an airline receives fewer aircraft than expected, they protect their highest return routes first.
Lower return regional routes are the first to be cut or postponed.
The factory sees a missing actuator. You see fewer direct flight choices.
We also see clear shifts in the secondary market. Lessors sit between the factory and the airline.
A large lessor with a modern fleet and immediate access to capital holds immediate capacity.
When new aircraft are delayed for years, that scarcity grants the lessor immense pricing power, keeping lease rates and residual aircraft values structurally high.
Looking at those older aircraft remaining in service, you might assume the clear financial winners in this cycle are the maintenance, repair, and overhaul networks, the MROs.
Older planes require more shop visits, which should mean a windfall for repair providers.
Well, I would push back on the assumption that MROs are the clear beneficiaries here.
Because of the structural shortages.
Yes, it is true they are seeing record demand because older aircraft and engines remain in operation for longer.
But increased demand does not automatically translate to easy margin.
Repair providers face the exact same structural shortages as the original manufacturers.
They are short of certified aviation technicians.
They're short of spare parts from the exact same Tier 2 suppliers.
And they're short of physical shop capacity.
The bottleneck simply moves from the final assembly line to the repair bay. It does not disappear.
Furthermore, managing these rolling delays across the entire ecosystem requires massive amounts of capital, which introduces a critical macroeconomic vulnerability.
The financing hurdle is substantial. Commercial aircraft are among the most expensive mobile assets in the global economy.
Airlines finance them through bank lending, capital markets, operating leases, and export credit.
Boeing's aircraft financing outlook explicitly expects funding requirements to keep rising as manufacturers attempt to ramp up deliveries.
Solving the factory constraint creates a secondary macroeconomic test. Can the global financial system efficiently fund these aircraft when they finally arrive on the tarmac?
That introduces severe foreign exchange and government friction.
Aircraft financing is heavily dollar-centered.
An airline operating in India, Japan, or Europe collects its daily passenger revenue in rupees, yen, or euros.
However, their aircraft leases, debt obligations, and fuel costs are priced in US dollars.
Interest rates, exchange rates, and credit spreads can severely alter the economics of a fleet without a single physical component changing on the aircraft.
If the aircraft is delayed by 18 months and the dollar strengthens significantly during that delay, the airline's capital expenditure just spiked.
A production slot is only useful if it can be financed when it eventually turns into a delivery.
Furthermore, governments are increasingly pushing aerospace manufacturers towards supply chain resilience.
They want to subsidize local industrial capacity. But resilience requires duplicate tooling, extra buffer inventory, and geographically diversified supply chains.
This reduces geopolitical dependency, but it fundamentally raises the fixed costs of manufacturing.
Aerospace is being forced to pay for both efficiency and resilience simultaneously.
This brings us to a sharp, contrarian macro risk that the market may be mispricing.
Scarcity changes corporate behavior.
When airlines worry that future aircraft will be unavailable, they order earlier to secure their place in line.
Lessors secure future production slots purely as defensive maneuvers.
Backlogs become longer. The attempted solution to the shortage makes the queue look even more formidable.
But you have to model the other side of that cycle. What if the supply chain finally resolves its bottlenecks exactly when passenger demand weakens?
Imagine that Boeing, Airbus, the engine manufacturers, and the global supplier base finally succeed.
Capacity expands, productivity improves.
Deliveries accelerate.
If global passenger demand softens due to a macroeconomic downturn at that exact moment, airlines may attempt to defer the aircraft they ordered defensively 3 years ago.
The shortage we see today flips rapidly into an excess capacity problem.
Assuming planes will always be scarce is no better as a financial forecast than assuming the supply chain will magically fix itself next year.
The decisive risk is whether industrial capacity and real airline demand arrive at the exact same moment.
That cycle risk leads directly to our final strategic takeaway regarding who actually holds power in the aviation industry.
The governing equation survives regardless of which specific aircraft models are being built.
Before an order becomes a delivered aircraft, the manufacturer must coordinate capital, technology, commodities, energy, manufacturing, logistics, suppliers, regulators, financing, and the final customer.
It is a contest of converting immense industrial complexity into repeatable, profitable output.
Therefore, the structural winner in this cycle will not always be Boeing or Airbus.
Sometimes it will be the airframe manufacturer, but often it will be the Tier 1 engine supplier, the large-scale lessor, or the early-moving airline that secured its fleet before capital costs rose.
The ultimate winner is whichever entity controls a scarce constraint without allowing that same constraint to damage its own balance sheet.
And as you evaluate this sector, consider this as we transition toward electric and hydrogen aviation over the next 20 years. We're going to have to rebuild this entire impossibly complex supply chain from scratch.
If the global industrial base cannot build traditional turbine engines fast enough today, what happens to working capital and delivery timelines when the entire industry has to master a completely new science tomorrow? Subscribe to the Unlayered Global and tell me in the comments. Over the next generation of aviation, which advantage matters most, the manufacturer with the biggest backlog, the supplier controlling the bottleneck, or the company that already owns the aircraft?